Okay, testing. Hello, hello. Is anybody out there? We will find out shortly, hopefully. And see if anybody can hear me. I don't think this would affect you guys because you just go to the link, but the date on this one was mislabeled, I think. Shouldn't affect anybody though, because I think you just follow the link to get here. Anywho, see what's going on in the markets. Actually, nothing's going on in the markets. Nice and flat, so we don't have to worry about that. See what things we do have to worry about. Certainly, there's going to be some stuff to worry about. All right, let's see. Corey can hear me. Here comes people. Good, thank you guys. And screen should be now sharing. Let me know when that's working, and then it's time to go. First, a refreshing tea drink. All right, that sounds good. Got to be some fun stuff to do today, right? Screen's coming out good. People can see. We're going to be good to go. All right. So, none of this matters. Let's look at the charts, actually. That's a better place to go. We'll take a look at the actual what's going on charts. So if I am signed in. So if I go to charts and tools, is that where it is? Phil Davis, your account. Nope. Oh, there it is. Default list. Oh, do I not have these charts up already somewhere? No, apparently not. Okay, so let's see. The thing is in naming, because I don't know how to get rid of them. Do you think they have one of these buttons? Doesn't look like it, does it? Point and figure. Nope, very annoying. All right, so March 22, May 22, that's got to be the most recent one. Got to be a way to delete them. It's very frustrating. All right, anyway, so there's my good old chart. So where are we now is the question. And we're still, so in other words, look, we're consolidating under 4,000. This is still a generally bullish chart. Here's where your danger zone is. So you've got, and again, you know, this is not, don't mistake this for TA, okay? This is, all we're doing here is using math to calculate what this chart's going to look like in the future. I don't need to use a candlestick pattern or anything else to predict this. It's math. But the problem is most people have such a vague understanding of math that they'd rather look at the pictures. But all charting is just statistics put on paper. It's math put on paper. It's not, there's nothing inherently predictive about a chart. And that's why all of TA is just such complete bullshit. It does show you a trend. There are trend lines. But again, the trend lines are mathematically interpreted. So understanding that lets you understand how a chart is being made. And if you understand how a chart is going to be made, then you can predict what's going to happen. But it's not because you're predicting something using these stupid lines. It's because math tells you what's going to happen. So what is happening now? We are 100 points below the 200-day moving average. So very simply, you say, well, we're 100 points below, divided by 200-day moving average is half a point per day. So the 200-day moving average is being pulled down at half a point per day. As long as we stay here or higher, right, it's going to be half a point per day. If it's half a point per day, it's going to take a full 3 months. Not 3 months. When I'm talking 200 days is a lot. It's 6 months. It's going to take 6 months for the 200-day moving average to complete this journey. That's a long time, right? So if we stay up in this zone, then the 200-day moving average will barely budge from here. It will stay over our center line and be bullish. If we start moving higher, this will go even slower, right? A lower I forget, numerator, whatever you call the top part of the thing you divide by. Anyway, it'll be a little, let's call it a numerator. We'll assign the word numerator to it for now. So it'll be a lower numerator. The denominator, 200 days, remains the same, and therefore you will get a slowing pace. So in other words, if this were 50 points, it'd be moving 0.25 per day lower. So as long as we stay around 4,000, this is going to take 6 months to fail that blue line. So anything around 4,000 is bullish because, not because of the chart, but because the long-term average will have a chance to relax and flatten and will no longer be putting the downward pressure on the market. Okay, and again, it's not because of the chart, it's because of all the people who follow the chart and believe it. In other words, if you wave a red flag in front of a bull, he will charge at you. Okay, it's science, it's not math, and it doesn't matter it doesn't matter how many red flags are on the chart. If the bull is here and the red flag is there, he will charge at the red flag. It attracts his eye and it enrages the bull. So it doesn't matter. What we're doing is we're predicting the actions of the people who follow the charts, because we know what the chart's going to look like, and therefore we can now predict the actions of 90% of the people we're trading against in the market who follow TA. That's very useful, right? Now, at the same time, we are 793, we're 200 points above the 50-day moving average. But then if we're 200 points above the 50-day moving average, then we divide that by 50. That means the 50-day moving average is rising at 4 points per day. So this is barely falling, and this is rising at 4 points per day. All right. How many days? So this is like, now this is one of those two train problems, right? How many days before the 50-day moving average, if we stay here in this zone, how many days before the 50-day moving average intersects the 200-day moving average? Well, the answer to that is going to be, I forgot how to do it. Anyway, there's a mathematical formula for figuring that out, but the point is, let's say I can guesstimate it better. So how many days will it take this to move up? Well, it's going to take 50 days, right? It's going to take 50 days. It'll take 50 days for this to come to this level. So in 50 days, where are we going to be? In 50 days, the 50-day moving average will be at 4,000, and in 50 days, this will be 25 points lower at 4,025. So basically, there's your answer. Roughly 60 to 75 days. So in 2 to 3 months, you will have, if we consolidate around the 4,000 line, in 2 to 3 months, the 50-day moving average will cross the 200-day moving average in a bullish fashion, and you'll have rally fuel. And this goes back to what's happening in 2 to 3 months, earnings. So until that happens, there's not much going to be going on a technical perspective to be more bullish. And all that is, of course, only if we stay around where we are now, if we keep consolidating around this line to the end of the year. So the question is, what catalysts do we see that are going to affect the range we're trading in between now and the end of the year? We've gone past earnings. So we're not going to get a boost from earnings. We know the Fed is going to tighten again. The only question is whether they say they'll tighten a bit less, or they'll step back, or they'll pause, or whatever. That could rally the market. But we have Black Friday coming up, so depending on how that goes, again, that could rally the market. But Black Friday keeps being a bust because of Cyber Monday. So it's like more people order stuff every year. More and more people order things online rather than going to the stores and being idiots on Black Friday. Being a non-COVID, COVID's pretty much not being a factor this year, so maybe more people will be at the stores. The comps from last year also should be a lot better. We'll see. So that depends. Depends on inflation, depends on fuel, depends on a few things that happen over the next couple of weeks. But either way, after Thanksgiving, the Fed is going to tighten again. So it's hard to imagine we're going to get a rally that's going to take us much higher than 44. By the time we get to 40, 50, the S&P will be here, and we're still going to have that downward pressure and it's going to be all the way into Q1 before we're going to be able to have a serious catalyst like the Fed pausing, or like better than expected Q1 earnings that'll get us over the hump. So, so my attitude is saying, well, if nothing much is going to happen over the next 3 months, then why are we going to take the risk of holding our portfolios in case something bad happens? Okay, those are all the good things that could happen. What about all the bad things that could happen? There's lots of those. So it's tricky. Of course, then on the other hand, we have Santa Claus rallies for no reason at all. So that makes it even harder to predict. Where's my NASDAQ chart? That one, I guess. Yep. And the NASDAQ is pretty much in the same position, except in this case, these are weeks though. This is the 50-week moving average, which is a 200-day moving average, right? For the other chart, for a daily chart. This is the 200-week moving average. So that's going back 4 years. So the 4-year moving average for the NASDAQ has been steadily climbing, but this will take forever to happen. But what's actually happening though is if we keep consolidating along this line, we're going to have a death cross, but that death cross will take forever. So it doesn't really put any technical pressure on the markets because these are weeks. Here you have 1177, 13.1 is what, 1,400 points, right? So 1,400 points divided by 50 weeks. 28 weeks. Going to take, again, it's the same 6-month thing that we're dealing with in the S&P, right? They're both telling us the same thing. In 6 months, we're going to be at a serious inflection point. So if we keep consolidating around these levels into the end of the year, we're basically going to be saying after Q1 earnings, which will be, well, I mean, it'll be Q4 earnings. After Q4 earnings are announced in Q1, when we get those earnings reports, we're going to be all the way into February by then. It'll be February, March by the time anything changes. And that's what the charts are telling us. We're 6 months away from inflection points. So that's how you use a chart. You use a chart to say, here's what these TA people are going to be looking at in 3 months from now, 6 months from now, 3 weeks from now. You can see whether or not something's going to happen. Then you say, okay, given that, what fundamental factors are going to move this up or down? But even if it moves up drastically or down drastically, if it stays in this range, you're still going to get the same progression of these lines converging at some point. And when those lines converge, then you have a meaningful TA event. But again, it's only meaningful because so many people read into it, because so many people follow this crap. It doesn't change what SunPower is making in revenues. It doesn't change what Target is doing to turn around their bottom line. It's just a freaking line on a piece of paper. It doesn't tell you anything. When you're looking at an individual stock, it's telling you what people think it's worth, but it doesn't tell you what it's actually worth. It's just telling you a gallery. So if we look at Target, which just had a hell of a hit today, look at 12.4%. So that's a good example. In fact, we should talk about this. So we look at Target, and Target fell 12.4% today, but it's only back in the range it's been in for a while. So this is not a surprise to anyone who's been trading Target for the last 6 months, right? They had a totally crap report in May. Okay, August wasn't as bad as people thought it was going to be, and now we're back to, oh no, actually it's still pretty shitty. People just took too much of a relief out of August to say it wasn't as bad, but the expectations were already for shit. Target said we're going to have a bad year. They're having a bad year. There's no question about it. But they also say, and this is the funny thing, they said they were going to have a bad year. People didn't believe them. Now they believe they're having a bad year, but they say this is only a bad year and we're going to be fine next year. Nobody's believing that. It's an interesting thing. But you look at the charts, they're telling you the story. So, these are the ranges you should be. This is what a chart is useful for. This was the most anybody in the last 200 days thought this thing was worth. In 200 days of trading, 200-day moving average, in 200 days of trading, nobody thought this thing was worth this much. Not one person trading in the last 200 days thought that it was worth more than this. So when you hit that piece, you say, damn, we better be having spectacular earnings tomorrow or this thing's going to pop back down to the bottom of the range. And it didn't pop back down to the bottom of the range. It broke totally through the range and went much further down. Although, again, this is probably an overreaction. All right, so let me go to Target. Let's take a look at Seeking Alpha. Target. So Target says things a bit. Oh, very important. I was trying to make a point this morning. I don't know if I made it well, but I can make it. I don't know. How can I draw something? There's programs for drawing, right? What do you draw things with? Draw, paint, thank you. Paint, okay, so good. So here's paint. All right, so triangle making tool, thank you. I've never done that before. Ooh, isn't that cool? Okay, this is not what I want though. What kind of, can you adjust the pieces of a triangle? What if I do that? What if I do this? Can I pull that one? It'll only, oh, here's a triangle I want. There you go. Dun, dun, dun. Good. Okay, so if we have a, all right, so you have to think of the consumers, right? And let's do some lines. So we're gonna say, line. Oh, it's, nope, not that. Okay, it's going good though. Okay, so size, my lines. Okay, we're gonna say, oh, okay. So that, and that, and that, and that. Okay, so then we're going to say dollar store. Oh, I should have moved it. Walmart, Target, Macy's, and you know, and Nordstrom's basically, and JWN. Oop. Okay, so here's the problem Target has. You're having a recession and inflation, and people, the consumers, have less money to spend than they had last quarter. So what happens? Everybody shops down a little bit. The rich people, actually, this is where Macy's gets hit too. The rich people, they don't really go down. It's very hard to get someone to go from Nordstrom's to Macy's. You know, if you're a Nordstrom shopper or a Saks Fifth Avenue shopper, you're probably not going to go to Macy's. You're not looking to. It's not enough. You're not being hit economically enough to probably make a switch in your habits. So Macy's suffers because very few people are going to switch to Macy's. Macy's loses people to Target, basically, right? Some of Macy's customers are going to bleed out to Target, but the problem is there's a lot less Macy's customers than there are Target customers. So the amount of people they lose to Walmart is a lot. And the Macy's people who might drop down to Target, obviously it's a very big simplification, but the Macy's people who come down to Target are not going to fill the gap enough for the people who are going from Target to Walmart. That's where Target gets some substantial amount of people who trade down looking for cheaper stuff than what Target has. Because if you think about where Target sits in the chain, you go to Target, it's got good value stuff, but it's not bottom of the barrel or anything like that. It's like just an off-brand, supermarket, and it's an off-brand Macy's basically, with some supermarket stuff in it, and more of and pharmacy combination too. Anyway, so Walmart loses people to the dollar store, but the economy isn't really that bad yet that people are going to the dollar store to get their groceries and shit. It was in 2008. 2008, the dollar store did fantastic because everybody was like Target, Walmart, everybody was hurting because everybody was at the dollar store buying their stuff. It was like these want the cheapest possible thing because they had no actual money. We're not there yet. People still have money, but they're worried about it, and they're ratcheting down their spending. So that's what I was trying to get across today. I should have drawn this today. Actually, it would have made more sense. But you have to realize the position Target's in. They're in a very bad spot because they are mid-market, and it's just a numbers game, really. It's how many people are trading down. There's not enough people up here to refill what Target is losing to Walmart. And Walmart is fairly sticky. They've been doing a good job of negotiating prices and things like that. I mean, they just announced their own thing. Oh, well, anyway, all right, we'll get back to Target in a second. Oh, okay, that'll be nice. We can look at their presentation. This will be fun. Click to enlarge. Let's see what they have to say. Fourth quarter, consolidated, they had some sales growth. Comp sales were up. Operating income increased a little bit. Adjusted earnings per share declined slightly. So, they had a not easy going. Net sales growth 5.5%, excluding divestitures. Consolidated growth 6.5%. Comp sales growth, excluding fuel, 5.5%. Operating income declined. Company's guidance declined. See, they had already guided to a very low number, so everybody was kind of relieved. Target guided to a low number, but everybody forgot about it because they got it to it in quarter one. Okay, so revenues up, okay, but that's inflation. Don't forget, inflation is 9%. Okay, revenue constant currency. That's weird. I'm not sure what they even mean by that because that's a kind of weird thing. Membership and other income, 1.5. Oh, that's good that they got the membership growth. That's smart of them too. Sales are up with inflation. Constant currency, it says up. How can you be up with inflation and be up constant currency? It doesn't make sense. Gross profit rate down a bit. Operating expenses, operating income. Tax rate is, what the frick is that? Minus 159%. Oh, earnings per share. So they're declaring a loss, but then they adjust it back to $1.50. Whoosh, wow. Inventories, accounts payable. The inventories are up a lot. Fiscal 23, dividends, share repurchases, 8.7 billion in share repurchases. That's also boosting their earnings per share substantially. That might be why we got those wacky numbers. Walmart US, Walmart, oh, I see they're breaking it down there. Quarterly merchandising highlights, grocery, comp sales, mid-teens. Wow, a lot of people switching to Walmart for groceries. Oh, and then Walmart International, that's where currencies come into play more often. Oh, and Sam's, oh yeah, you forget they have that whole membership thing with Sam's Club too. So that's where Walmart is. But Target is not, where is this Target? Yeah. Target. Here you go. So Target is making the same $1.50 a share that Walmart's making. Let's keep that in mind. Okay, we'll take a look at the comps. I guarantee you, it's a big difference. So revenue and the shares are down tremendously. Comp sales increase, same stuff. On top of 12% growth last year, driven by 1.4% traffic. Blah blah blah. It's just not enough to make the investors happy. but it's not like the store's falling apart. It's not like they're dying. Here you go. So keep in mind, they're both making $1.50 a share in the same quarter. Target shares are $150, and Walmart shares are $150. They're making the same amount per share. Yet Walmart is rewarded, Target is punished for basically having the same earnings. It's really weird. It's not like they're having different quarters. It's not like they have a different situation or anything like that. It's very, very close, but Walmart is just showing, I mean, like I said, in that pyramid thing, Target's just showing a bit more deterioration than Walmart. It also goes back to an efficiency issue because, again, like I've been saying, we have to be very careful about any kind of companies that have a lot of employees because, in general, more employees is more raises, and more raises is more problems. So, we don't want to be too heavy into these companies that have lots and lots of people on the floor. See if there's any questions. Nobody has any questions, so we'll move right along. Now, off that topic, petroleum status report. Just see how this is going. Oh, what's oil doing? It was not good last time I looked. Yeah, hovering around $85. The report was not taken particularly well today. There's the reaction to the report, and it wasn't a big deal, but they're just looking for something that's just not, it's not there. Let's see, November 11th, that seems like the right date. Commercial crude decreased 5.4 million barrels. Now, so the oil decreased by 5.4 million barrels, but we have 2.2 million billed in gasoline and a 1.1 million. So you always want to look at the net. So the net's 3.3 minus 5.4 is 2.1. So 2.1 million draw. It's not awful, but it's not bullish really. It's just a normal thing. Here's the problem though. Only 4 million barrels were released from the Strategic Petroleum Reserve. It went from 396. Well, I'll start to make this bigger. So the Strategic Petroleum Reserve went from 396 to 392. Okay, that's not a lot of draw on the Strategic Petroleum Reserve. And as usual, we're exporting 4 million barrels a day out of the country. And if we weren't exporting 4 million, we have a 2 million barrel draw for the week, and we're exporting 28 million barrels in a week. So that's crazy. The imported oil is down again. Last year, we were importing 3 million barrels a day. Now it's less than 2 million barrels a day. So that, again, that's 7 million barrels a week less imported oil, 3.5 million barrels more exported oil every week. And that just makes a massive difference. We are refining oil for other countries, and we're shipping our oil out of this country. And look, there's a war on. It's necessary. It's the right thing to do. We're all shouldering the burden of the Russian situation. This is what allies are for, right? So what's happening now is not a terrible thing, but it was happening long before the war. I mean, we look last year, we were exporting 3 million barrels a day. So there's no reason the U.S. should be paying this kind of money for oil, not for oil, for gasoline in the at the pumps and stuff. But the problem is that we refine oil for other countries. We don't refine it. We obviously refine it for ourselves, but we refine it for other countries, creating a shortage of supply in the U.S. That's no reason to have a shortage of supply in the U.S. We elect to send the oil out of this country. If that was addressed, it would make a huge difference. And that's why you'll see some people say, well, why aren't the oil companies spending money on exploration and production? Because there's no demand in the U.S. for more oil. There is no demand change at all in the U.S. You know, we're using 20 million barrels a day of refined products are being created, right? So 20 million barrels come in, 20 million barrels of refined product go out. But of that 20 million, 4 million, which is 20% of this, is shipped out of the country. If we didn't ship it out of the country, we would have a weekly build, because this is daily. We would have a weekly build of 28 million barrels a day. In 50 weeks, that would be so it's 20 million barrels a week. Sorry, so 28 million barrels a week times 52 weeks is 1.45 billion. That would be more oil, or as much oil as we have stored total in this country. That's how much excess oil we're shipping out of the country. Our entire strategic petroleum reserve is being shipped out of the country. And that's why, you know, and I said this for weeks now, it's all going to collapse because it's just not being required. And as soon as the economy slows down even a little bit, this is a real house of cards, these oil contracts. And they are going to be screaming to get out of them. So no, I'm not bullish on oil. You know, natural gas is a war situation. That's another big one. So we would have floods and floods of natural gas, but we're exporting the crap out of it. We're sending it all over the world. It's we're the Saudi Arabia of natural gas. We don't use hardly any of it at home, and we send it all overseas now. But these oil companies they don't know what to do, because the answer to why the oil companies aren't spending their money developing new fields is because, you know, it's a 3-year development cycle to get a new field up and running, and it's got a 20-year lifespan, and you expect to be sort of break even after 10 years. So it's basically 13 years to break even on an oil well when you start, you know, when you begin drilling and expanding and so on and so forth. Now you get all your money back plus a profit after 13 years. Everything you sell from that point forward is pure profit. That's fantastic. But the problem is 13 years from now, the oil companies aren't even sure whether there's going to be a demand for oil 13 years from now. We're going to have more and more electric cars, and demand is going to go down and down and down. And what the hell are they going to be doing with all these oil wells? Especially if it causes prices to drop below their target prices, and let's say they need $50 oil to make these wells profitable, the new ones they drill. What if it goes down below that? These guys are facing possible bankruptcy if they start investing in oil now. Plus, you don't know if they're going to crack down further on fossil fuels or start fining, or if they're going to have to buy offsetting carbon credits for what they sell. They don't know what's happening. So, you know, it's partially just a failure of government to deal with this stuff, because it needs to be dealt with. And I mean globally, it needs to be dealt. I mean, we should be having like nonstop UN meetings to figure out what we're doing about climate change and how we're going to handle it and how we're going to transition. We have to help the electric companies transition, because we're taking away their customers. Every time you have this program to install solar, right? And every time you install solar, you're taking a customer away from the electric company. Their business model doesn't really account for that. Their business model is to provide electricity for everybody in an area, and they've got these population models saying we're going to have this much growth and we have to invest this much and we do this, and they got the same boat. They build a nuclear power plant. It's going to take 20 years to break even on a nuclear plant. You know, and they don't know what to do. They don't know if they should put up a coal-fired plant. Well, that's out probably, but a gas plant, a nuclear plant, solar plants. They don't know what to do with themselves because there's no clear direction for what to do. And it's a very tricky game. I mean, you make a miscalculation and you can't stop it. If you start investing in hydroelectric, like let's say someone had built a $100 billion dam, like Hoover Dam, further down the Colorado River. All right, and they like re-dammed it up or did something, and then we're trying to could you imagine the environmentalists? But let's say further down the Colorado River, they said, well, we have one dam, let's build another dam and do it again with the power, and have the power run off twice. Could be done, realistic. It's a potential thing to do. Cost a fortune, would destroy the environment in a region. It would flood out a huge mountain area. But you could do it. But this project, if they do that and then they find out that, but the Colorado River is drying up and there's not going to be enough even to power Hoover Dam, and both dams will be screwed, and we're going to spend $100 billion on a project that has no effective return. So how many people are going to go bankrupt on that project, and could that money even put to better use? The time, the money, the energy, and everything you put into it, you should have been doing something else because what you did wasn't realistic. This is what government is for. Government is to plan these things and to tell and to give a direction to industry. We're so against that in this country. It's like we'd rather have a Lord of the Flies sort of economy where like nobody's in charge and it's just complete chaos than have any leadership. We don't want to hear anybody telling us what to do on any situation, and that's crazy. Because you have to have somebody who's got their finger on a long-range plan and says, hey, no, we need this. Because we're taking everybody eventually off the electric grid. Or well, not everybody, but anybody can have solar. 50% of the homes in the country could have solar powering almost all of their homes. They're all leaving the electric companies. The electric companies have no plan for this other than bankruptcy. But we can't afford to let the electric companies go bankrupt, because what happens to the other 50% of the people? So what's the alternative? Does the electric company charge you double if you don't have solar? And of course, it's not one electric company, it's multiple electric companies. So electric companies in different regions are going to have different problems. So they're being attacked on their customer base. They're being attacked on, and again, we have no population growth. So there's nothing to support it. They're just losing people. And now we have no housing growth either. So there's no new homes, there's no new nothing, there's no new business for these guys. Look at the hit they're taking on offices not being filled up. All these utility companies and such that used to have the electricity flowing to all these offices that are still 30-40% empty in downtown areas. There's long-term repercussions to all of this stuff. And what you would need to do is to centrally plan it. As soon as you say central planning, everybody's like, oh, freaking communist, God, central planning, what's that? But we have no plan. We're just like haphazardly doing everything. And it's crazy. But meanwhile, we have to take that into account in our investing decisions and say, okay, well, it's crazy, and that's what we're doing. So we need to think about that going forward. But it makes you think, that there's a reason we don't have any utilities in our portfolios. We really don't have any oil companies in our portfolios. They're in very dangerous spots because it's very hard for them to make money or to be sure they're going to make money in the long term. We bought Chevron. We didn't buy Chevron. We actually just sold some puts on Chevron. But we sold some puts on Chevron just because they're heavy into natural gas. We have Total Energy because they're getting away from oil. Their investments, they're taking all their oil money and putting it into renewables. They think this whole oil scam is ending, which it is. Let's see. So who do we have? We have Chevron somewhere. There it is, Chevron. Yeah, it's the only 5 short shares in the long-term portfolio, and they're miles out of the money, so it's not like, But you got to be careful with this stuff, and that's what we got to look through all these positions and think about whether or not we're going to keep anything. Let's see. Oh, how's our $700 a month portfolio doing? 6.3%. All right. When did we start? 825. So that's pretty good, right? That's 3 months. So in 3 months, we've got 6.3%. And I think we were talking about making 20% a year would be fantastic, right? I think we said 10% would be great. 20% is going to be way past our goal. It's not that hard. It really isn't. That's the point of this portfolio. It's like all we're doing is taking $700 a month, putting it into a portfolio and seeing if we can make money. And in 3 months, we're up 6.2%, 6.3%. And that's nothing because eventually we're only in the very, well, 3 months. We're $2,100 into this thing, right? So there's $2,100 been put into this thing. And eventually there will be dividends. And when the dividends start coming in, this thing's going to start rapidly knocking up. So this is just laying the foundation for the portfolio in the first year of $700 a month. We're going to barely have anything that's really paying us off. We can't even sell options yet. You know, we sold some puts to take a position, but oh, and look at that, they're up 20%. Aha, that's good. So I mean, that's crazy, right? Because I mean, you just did that a month ago, not even a month ago, 11/3. So 2 weeks ago, we sold some puts and they're up 20% already. It's just like anything else, though. It's just like if you invest intelligently and diversify your investment, and you use the whole concept to be the house that we teach people, which is just not a difficult thing. And again, it goes back to math. The only thing that will absolutely happen in trading is that, when you look at these, here's AT&T that we said, okay, you look at AT&T and you look at these, this is the separator line, right? This tells you where the stock is basically. So if I sell this $1.04 in March, on the March 19 calls, AT&T is at 1880 something. So I collect $1 for the March 19 calls. For a fact, a scientific mathematical fact, this entire dollar will expire worthless. The premium is not the strike value. It does, the option itself may or may not expire worthless. So the $19 option may or may not be worth a penny or $1 or $2 or whatever, but that's not the premium. That's the value of the option. So AT&T might go up, it might go down, but I know for sure I'm going to get $1 for selling 121 days of AT&T. My 121 days, I get $1. It's a mathematical, scientific fact. And if I know that, and then I say, well, wait a minute, if I'm willing to sell these, am I willing to buy more AT&T? And if I say, yeah, I'll buy more AT&T. If I sell the 19 puts for $1.20, now I'm collecting $2.20. And I can't possibly lose on both sides. So now any movement AT&T makes, it's less than $2.20 away from 19. So from $21 to $17, I will make money. Plus I've got my stock and plus I make a dividend. Now, if I make $2 every, 4 months? If I make $2 every 4 months in premium, that's $6 a year in premiums against my $19 stock, which pays me a dividend. Now, if AT&T goes up, I will get called away. My stock gets called away, right? If AT&T goes down, I will buy more AT&T, but I will buy it for $6 less overall. I'm saying, and again, I'm saying you roll the calls and puts along to the target, but if you end up getting assigned, you're still collecting, all those premiums are going to be collected by you. So if it's $6 a year that I'm able to collect against my $19 stock, that's like 30% right there. That's premium. It will expire worthless. It's an absolute fact. It will expire worthless. I may get my stock called away. I may have to double down on my stock, but either way, I'm getting my 30%. That's what we're doing in the $700 a month portfolio. It's a mathematical certainty I'm going to get 30% in premiums. It is a possibility I'll get called away, which doesn't hurt me at all. and it's a possibility I may get assigned more stock. But if over the course of 10 years I intend to acquire more AT&T stock, I don't really care if I get assigned more either. Not when I'm collecting 30% in premiums every year against it, not including the dividends. So when I get called away, I have an extra profit and I'm called away. When it goes down, I'm buying the stock for a 30% discount to whatever it started the year at, because I'm collecting my premiums. Even if I do get assigned, I still keep the premiums. And if it's flat, it's just a huge bonus. I'm just getting a 30% bonus on the stock, plus still getting the dividends, plus I still keep the stock. The only way I lose is if AT&T drops more than 30% during the course of the year. That's the only time I lose. And again, if I'm accumulating it, I don't really care. I'm just going to own more of it next year, and I'm going to sell twice as much premium. So, you know, you want to stay away from stocks that are likely to drop tremendously, but of course, isn't that always our goal in stocks, right? You don't want to own a stock that's going to drop 30%. That would be something we try to avoid. So we start out by doing what? Well, there's several ways we enhance our positions, right? We start off by selling the short puts in the first place, and that means that no matter what, we're buying the stock for a discount. So AT&T is currently $18.80. And if I were to take a new position and just sell puts, I could sell the $17 puts for $2 in 2025, and that means I'd be assigned at 15. So that's 380 divided by 1880 is 20%. So my worst case scenario selling the puts is I would get a 20% discount on my entry. So if I'm assigned at 17, it's going to be net 20% off the price of the stock now. Or it expires worthless, and my, here I'll show you the margin. Single. So the margin for selling 10 of these guys is $1,200. I'm collecting $1,960. So I'm using $1,200 in margin. This is a portfolio margin, and I'm collecting $1,960. So it's very margin efficient. I'm not tying up any cash in my portfolio. If you have a margin account, if you don't have a margin account, you got to put aside. You're putting aside $15. You're putting aside $15,000, but still you're collecting 2 on 15,000. Is 13.3%. So you're basically paying yourself a dividend if you sell the put up front. It's not a strategy that's great for an IRA if you sell the puts, but it is a strategy that's great if you have a margin account. It's the greatest thing in the world. Because here I'm only putting away $1,200, and I'm only using $1,200 in margin to collect $2,000. So I'm not doing, so in other words, I'm not really doing anything. I'm not using any of my margin really effectively. I'm using none of my margin in my portfolio, but I'm setting up for a position. And so I'm either going to get some bonus money or I'm going to own the stock cheaply. Once I own the stock cheaply, I then sell another $6 worth of puts and calls. So my net 15 goes down to net 9. So the trick is just don't be in a stock that's actually going to go down from 18 to 9. If the stock doesn't drop 50% on me, I'm going to be fine. That's the only scenario where it starts hurting me is if it's down more than 50%. And even then, if I'm early in the position, if I'm early in the scaling, I'd be like, so what if it's down 75%? I can double down. But would I? With AT&T, sure I would, because it's not, you know, I can't imagine a scenario where they're going to go bankrupt on me. But and that's why the outlook, what you got to do is look for these companies over the next few years that are going to survive under almost any circumstance. And even if they don't thrive, we can still make money on them. You know, take up now. None of this stops things from trading down like crazy. You take Boeing, and people were trading them like they were going bankrupt in 2009. And still people consider it is a volatile stock. It's a pretty volatile stock. But is Boeing going to go totally out of business? It's so doubtful, right? I mean, they're the #1 plane maker in the world. And you think about, okay, what if there's a horrible recession and nobody buys planes, whatever? Well, if there's a horrible recession and nobody buys planes, I sure as hell don't see any competition springing up to start making them, right? Because it's like, you know, think about the factories and the number of employees they have and their supply chains that they develop and the relationships. It's like a decade's worth of work to even begin to compete in an airline, in an aircraft maker. It's not an airline. People start airlines all the time, but the maker of the aircraft, it's really Boeing and Airbus and a couple of small guys. And they've been saying for years, oh, the Chinese will do this, the Chinese will do that. No, they won't. It is not that easy. It's a huge investment and massive projects, and the Chinese don't see the market for their planes. You know, eventually will they be a threat? Possibly another 10 years or so, maybe, but it's not on the immediate horizon. So anyway, so even so though, you can sell Boeing $110 puts for $10. $110 is $65 below the current price. All right, and again, because it's way down there, it's going to be margin efficient for a portfolio account. Whoops, sell single. And here we make $9,800 or $10,000, right? And it's $4,400 in buying power. Those are great ways to start a position, right? Because all that can happen to me is I can be assigned Boeing at 110. The problem is though, are you going to have the conviction at 110 to take the assignment, and are you going to have the ability to take it? Because you can pretend you want to buy anything, all right? But Boeing, chart. Where can we see this? No. Okay, so here's Boeing. So Boeing was doing good in 2000, fell down, basically lost, what, 50% here, right? Then they go way up to 100, so they're up 300%. Then all the way back down to 30 again, all the way back down to this floor. So you could buy Boeing when it was here at 75 and say, well, it was 100 and something, I got it 75. I'm willing to stick with it no matter what. And then it drops to, 50. Or say, let's say 20%. So 20% of 75 is what? 60. So it drops to 60, 20% down. You got to make another decision. Am I gonna cut and run? Or am I gonna stick with Boeing? You say, oh, it's Boeing, blah, blah, blah. Great. Okay, now it drops another 20% to 47. Whoops. Trying to get something that sticks in this area. Come on. Okay, maybe here. There, okay. 47, whatever. So now it drops to 47. Now you've got to make another decision, okay? Because if at 20%, on a 20% drop, your only real decision, so I'm being assigned my put, right? I took my put with a 20% discount. I'm being assigned my put here. I can roll it, I can do something else, but whatever. But basically now I'm basically in a position where I'm kind of owning Boeing. So am I going to cut my losses here and take the loss on the puts, or am I going to stick with it? Am I going to roll the puts, or am I going to establish a position? At 20%, you want to at least make the decision that if it drops another 20%, you're going to put more money into it. You don't have to make it. You don't have to, stocks go up and down 20% all the time. So if something drops 20%, what you want to do is decide, if it drops another 20%, do I want to keep it? And keeping it does not mean just not selling it. You've got to be prepared to reposition the stock in such a way that it will be profitable to you if it bounces back half of what it was. So if I buy it at 75 because it came off 100 and it goes to 60 and I say I'm going to stick with it, then it goes 20% more down to 47.50. Whatever. Same crap. Okay, 48 close. Okay, then it goes down another 20%. At this point, I cannot sit there and just say I'm still watching it. You must take action. You should never have kept it at 60 if you weren't prepared to put money into it at 48. Because the chance of getting back, and you can see what happened after, right? The chance of getting back to 75 in any near future is very slim. The chance of getting back to where you started is almost impossible. Probably you're going to languish in this range halfway back to where you were if all goes well. If it doesn't go well and it drops another 40% from there, then you have to say, well, okay. And again, you have to have that contingency in mind too. You don't double down on a stock and then say, well, if it drops anymore, I'm just going to sit there and stare at it. Then what did you double down for? That's crazy. You've always got to be willing to make the next move. And if you don't, pull the plug. I know it sounds extreme. It's like, do I want to double down on Boeing, double down on Boeing, double down on Boeing? You have to if you're going to stick with it. Every time you make move number 1, move number 2 and 3 should be a given for you. Obviously, the situation changes. If there's different information, make a new decision. But don't stick with the stock pretending you're going to buy it, but then when it actually hits the fan, you don't. And again, you also have to keep in mind, it's not just one stock that falls on you. Okay, so when we look at the long-term portfolio, and don't forget, in August, we cut half of the positions in the long-term portfolio, but because the market dropped so much, let's go back to this S&P one. So in August, I made, because of the chart, again, top of the range, we cut half of all of our portfolios in August. We were viciously cutting positions in August, but because it fell so much between August and September, we thought it was only going to pull back to here or maybe here. Because it came down here, we decided to start bargain shopping again. So in September and October, we went crazy and we rebought pretty much everything we sold, or bulked the portfolios back up. Now they're full again, but look at this gain we just got. We just got the gain we just got the gain I've been talking about. We got the halfway back to where we were gain, and I don't expect it to go any further. Then what are we doing not taking this money off the table? And if you look at the long-term portfolio, we're up to some crazy number. We're at $2.5 million, 400% up. We are not going to go to we're not going to go to $3.5 million next year. It's not going to happen. It's not going to be a great year. We should take this money off the table because we started with 500,000. And the short-term portfolio is completely nuts because that's at 3.6 million. So what's 2.5 and 3.6? We're at $6 million combined. We were looking for 5. We are at $6 million. We are at the mathematical limit of what we expected to be at the end of next year, and we're there now. So holding on is not going to change the math. We have to make massive adjustments either way, and the easiest way to do that is going to be to cash this shit out. This is a stupid amount of money to have in our combined portfolios right now. And it's because we were doing really well. We were doing really well in August. We were up around $4 million in August. We went short on the market. We got to we were over 4 million here. We were getting close to 5 million here, and this blows past 5 million. I think we were 4.5 or something here, because even though we fell, the short-term portfolio made so much money because we were totally short. The short-term portfolio made so much money that it offset all the losses of the long-term portfolio and more. Then we went long in the short-term portfolio. We changed everything, cashed out our long hedges. So in other words, the ultra short positions that we were long on, we cashed those out, left the short positions, and that boosted our profits to a ridiculous level. But again, it's because we called it perfectly. But why did we call it perfectly? Because we respect the goddamn ranges. And again, this is not math. This is just an illustration of this is not a chart thing. This is just an illustration on a chart of what we decided were going to be the correct ranges based on the value of the S&P, which was 4,000. So we said it'll go between 43.20 and 36.80. That's going to be the expected range for this year for the S&P 500. That's exactly where we are, and it's exactly what we're doing. But the point is, this is what we expected to happen. This is what is happening. And, people are saying, oh, I don't want to cash out, blah, blah, blah. Things are going so well because we pay attention and because we have a value and because we follow our plan. So you don't just abandon the plan because you don't want to stop playing. We're winning. Of course, you don't want to stop playing, but you got to quit while you're ahead because we don't know what's going to happen. I know what's going to happen here. I've known what's going to happen all year long. I don't know what's going to happen in the next 3 months. I'm not going to risk. I'm not going to risk $6 million, not knowing what's going to happen. It's not really risking $6 million. It's risking probably $1.5 million up and down. Not even up. That's the problem though. It's risking $1.5 million down. We could easily go back to 4.5 million if we don't play this correctly. It would be shockingly surprising if we got even $500,000 more in profit if everything goes well. Because we've maxed out a lot of our positions. You know, each position has a certain amount it can make. And we have hit that because the market moved up so suddenly. So we need basically new positions. And the safest thing to do is to cash out and start building new positions in the portfolio. A lot of them are going to be the same old positions that we have now. They're going to look the same, but starting from scratch means we're going to deploy it differently. Look at all these pluses on the short puts. That's insane, right? Look at the percentage of correct guesses we made. You know, this one's still a disaster, freaking Wayfair, but that's a leftover. That wasn't even, we were only accidentally on them because it was a leftover from a play. You know, Whirlpool, I'm not worried about Whirlpool. I'm certainly not worried about owning them at 150 minus 22. Yeah, that's the other thing. This lost its whole premium. Whirlpool's at our put strike target. Okay, so it's not like we should care. But again, this is the thing. For a fact, this $25,000 worth of premium will expire. Just not yet. For a fact, on Xerox, 25. Well, it's at 15. Xerox is in trouble. We do in fact owe $7,500 to this guy, right? I'm sorry, 10,000. We owe $10,000 to this guy. This is no premium already. The premium's washed out of that one. But we're only taking a $2,400 loss because we sold it for $7,800. So do we want to stay with Xerox? That's the thing. So what is Xerox's business? That's what we got to look at. And this is why, by the way, these portfolio reviews kill me, because just to decide on this put, I have to go to Xerox. Let's do a couple of things. First of all, what the frick is wrong with this company? What are they doing? So here's Xerox. Disappointing Q3 earnings. Yeah, somebody thought they were going to have a recovery, but he's wrong. A guidance cut, earnings miss, blah, blah, blah. So yuck, you know, right? Nothing good going on there. Non-GAAP EPS 19 cents, misses by half, basically. Okay, so $15 share, 19 times 4 is going to be 80 cents. So it's about 20 times earnings at $15. And so now we got to read these articles, figure out, and obviously other articles, but read a bunch of articles, figure out what they're actually doing, what's going wrong with them, what they're saying, and then see if we believe that their numbers make any sense going forward. And if I'm not willing to do this, why am I wasting my time? Like, why own it? This is gonna, hello? Yeah, it goes. So it's $2.5 billion. They've got $7 billion in sales. It's really sad, actually, right? They used to make that was something exceptional, most likely. So let's say they used to make a couple of $100 million. Okay, and this year they're making $100 million, and next year they say $300 million. Well, $300 million is pretty good for $2.5 billion for the company. So are they going to be able to do this is the question. And then how much? What do they owe? They owe $2.8 billion in debt. The entire value of the company they owe in debt. That times 5 is going to be $100 million off their earnings down the road. So where they're probably not going to be at 300, they'll probably be at 200. You know, right now it's still adding 5% to everybody's debt because the Fed, I don't believe they're going to be done tightening the Fed until 6%. Company like Xerox is going to not be able to, but they're not borrowing at prime. They're going to have to pay They're going to sell bonds at 8-9% down the road for their interest, so that you can't count on the debt staying where it is now. You know, their debt service is going to increase. So any company, we assume 5% more, because between the Fed tightening and so on and so forth, and the bond market, corporate bond markets going up, everyone's going to have a very hard time with interest rates. And that's again why you've got these analysts are now saying that the S&P earnings are going to be impacted. Of course they're going to be impacted. How is it suddenly a surprise to people is what the question is. Because I've been telling people the Fed's going to raise to 6% forever. Oh, come on, man. There it goes. So we had a couple of stories. I like that picture. It's cute. There we go. Oh, so what were we saying? Oh yeah, news. Oh, I forgot how much reading I did today. There's a lot of stuff. All right. Oh, and it's right there though. So, markets are getting ahead of themselves. Here's what we go. Okay, so here's a couple of articles in a row. And this is what they're talking about. Fed funds rate close to 5%, recession difficult to avoid, blah, blah, blah. He trimmed trimmed equity forecast in October, uneasy about the Fed's tough tone in geopolitics. This is exactly what I'm saying, basically. Far wary this autumn, noted how the stock market, some of the most shorted long duration pockets. Bond yields are likely to reflect the market. And that's the other thing, by the way, is because as bonds start going up to like 7%, people are going to stop investing in the market, especially if it looks shaky, and they're going to put more money into bonds, and that's going to cause a problem too. You know, people are going to balance more money to bonds, and well, they should, right? Don't you wish you had 7% bonds? Don't you wish I mean, instead of messing around with the market for the last 20 years, if you would just put your money in bonds at 7% and collected the interest, you'd be fine. You know, so we haven't had that situation in so many years. People forget what it's like, but there is a choice. Stocks are not mandatory. You know, we can do all sorts of cool, fun things with stocks, as you can see from the portfolios we have. But there's other things to do with your money than put it in the stock market. And if you don't understand how to invest and you don't have the proper strategies in place, you can really screw things up. Boy, I hope those are offset by some long calls. Anyway, so again, we got to evaluate each one of these positions and decide how much more can we make? How sure are we that we can make it? So like here's Disney. It's an 80-130 spread. So first of all, 130 is no longer a realistic target for Disney, though. That's one problem. All right, so Disney is way the frick down here. All right, and these are daily movie averages. So here's the. Oh no, I'm sorry, that's weekly. So that's a weekly average. So this is the 40-week average, which is the 200-day average, basically. So Disney's down here at 94, which is where we used to like them in the old days. So I know for a fact 94 is a good price for Disney, but the question is, where's our exposure on Disney, and what are they really worth, and what are they bringing in? So DIS, one problem I have with Disney, they have a cruise line. Everybody, you got to remember that they have a big cruise line. It's a big source of expenses and income for these guys. So COVID has two problems. COVID is still shutting down parks. Shanghai was just shut down. It also is shutting. It also is deterring the cruise line. Some cruise line just landed with yeah. No, 800 COVID cases. So Princess Cruises. Cruise ship carrying 800 passengers docked in Australia. In Sydney, Australia, Saturday, Majestic Princess, 4,000 people halfway through their voyage when an outbreak occurred. So halfway through, you got to look at the numbers. 4,000 people in 6 days had 800 cases of COVID. 20% of the people got infected in 6 days on a cruise ship. That's an outbreak. That's still happening now. This is from, wait, this is not from March 8th. It just happened. November 13th. Okay, yes, sorry. So November 13th. Apparently this picture is an old picture. So on November 13th, this just happened. 20% of the people on one ship got COVID in 6 days. So any cruise company, any company that's relying on ships and cruises for income is dangerous, and Disney is one of those companies. That's a problem. They also need their parks to be open. So COVID is a big issue, still around, still doing stuff, still affecting these companies. But they also have, well, it goes hand in hand though. They've got their regular parks, but their parks, they have a huge hotel operation in the parks too. They're massive, massive hotel operators. In and around the parks, they have hotels everywhere. And of course, they've got their ABC franchise, ESPN franchise. So sports are also, a lot. They get that. That's why they got whacked like this. I mean, they get super hit by COVID, something like that. COVID canceled the sports. It closed the parks. It closed the cruises. It's amazing they only lost. It actually shows you how strong the company is. They only lost $3 billion in 2020 with all their whole business under attack at the same time. All right, but they've got Marvel. They've got the movies, they've got the Disney Plus, they've got Pixar. So they've got, they've got a whole other entertainment franchise, but it's hard you can't ignore the stuff that costs them money. That's the problem because, with the theme parks and the hotels and the restaurants and the cruise lines, they're going to incur costs whether or not they're open. So that's very painful to a company like this. So, do we think they're going to make $7-9 billion? If everything is good, at some point, that's what they make. And you're buying the company for $170 billion. This is a pretty good price. It's not phenomenal though, because 20 times 8, let's call that 8. 20 times 8 is 160 billion, and you're buying them for 170 billion right now. So they're fairly valued, and they're fairly valued assuming COVID doesn't come back. If COVID comes back or some other disease comes back and closes things down again, you're way overpaying for Disney. So we have to look at every single position and we say, okay, well, I currently have a, what is that, $10,000 loss in this position. It's an 80-130 spread, but we're not going to 130. I'll be thrilled if we hold 110. So it's really only a $60,000 position. So I can only make $50,000 on this position. We have the 130 puts, it's a 94. So do I really, and here's the thing, it's not about whether I say, do I want to hold on to it? It's, am I prepared if Disney drops another, and it can because it's at 20 times earnings. What if it drops to 15 times earnings? What if it drops 25% from here? If Disney drops another 25% from where it is now, am I prepared to spend the money it would take on this position, and I can go through that math too, I have to roll this put. So we'd have to roll the 130 puts to 2 of the 2025 100 puts or something like that. I'm just picking numbers out of the air, but let's say I have to do that. So now I have to commit to owning 2,000 shares of Disney at $100. That's $200,000. Is that right? 2,000 times 100, yeah, $200,000. So I'm committing to $200,000 worth of Disney, and if I do that, that means I can't buy something else, right? So if Disney drops 20 more percent, here's the thing: why would Disney drop 20 more percent? Disney would drop 20 more percent because something bad happened, like COVID, like a recession. Things that are not going to be easy to recover from are happening to it, and I'm going to be sitting there putting more money into them. I'm going to wish I took my 10,000 off the table, right? So they're not going to survive. I'm telling you that now. I'm looking at it saying they're not going to survive a cut. I don't think they're bulletproof enough for me to want to say I'm going to take money and and throw $50,000 more into this position, trying to keep it alive when it's dropping like a rock. Because the reason it would be dropping like a rock would be because some horrible thing is happening. It's going to be hard for them to recover from. It would have to be more COVID or more recession is hitting them. And not only that, but God forbid, but a terrorist attack at a Disney park, which which hasn't happened, but something like that would knock this stock down for so long and become a nightmare, because they would have to then have security at extreme levels forever forward. I mean, even now when you go into Disney, it's like security. It used to be like, used to go la-di-da and walk into the park and go and just show your ticket and go. Now it's like you walk through like multiple little gates and things like that, and they check stuff. So yeah, since that's been going on since 9/11, that's been going on for 20 plus years that we've had amped up security. It's not going to stop. And if anything bad does happen, it'll get more security and things, and it makes the park experience less pleasant for people. And as we know, and the other thing, as we know, Disney is only being profitable. I mean, they're generating profits now by doubling their prices in the theme parks. I mean, the tickets are up double. Everything in the theme park's expensive. They sell these VIP passes now, where it's like, so the elites get to ride as much as they want and do whatever they want and walk past everybody, which makes it a much less pleasant experience for everybody else. And so anyway, so that's it's there's many holes in the premise for keeping Disney. And that's what we have to do with every single one of these stocks, is look at it and say, can I really make enough money to justify it? Don't I have something better I can do with my money? And I don't mean money, actually. I mean, here it's risk. It's all about risk, because the money is the zero. We lost $10,000, and this is a net zero. If we get out of this trade, it's net zero, basically. It's not like it's not like we care about this, it's the losses, but we're just cutting our losses. Oh, that's Dick, sorry. We're just cutting our losses at $10,000. So that's what this is about. I'm sorry. So the net of the position is 50 minus 40 is basically $5,000. We'll pull $5,000 off the table. It's not about the $5,000. It's about the fact that we're down 10,000, and we have to put a good 20, 30, 40,000 into it if it drops another 20%. And if it drops another 20%, it'll probably be for reasons that are going to make me not want to hold it. So every single position we have to look at like that and say, do we really want to keep it? Really, really, do we want to keep it? Is that really so important to us that we would rather have that than have cash, so that when something really does go on sale, we want it? And so for Apple, I'd say yes. For Alchemies, is this the same one twice? No, it's two different times. Okay. APD for Broadcom. And they also got to look at it and say, geez, I mean, 25% on Broadcom in like 2 months. So now to make the rest of the money, it's going to take me a year and a half. So wouldn't I be better off taking my $6,000 profit off the table, removing my $17,000 risk, and waiting to see what happens with the chips? Because the chips seem kind of iffy right now. You know, every position, it's got to be like, is this really worth keeping? Caterpillar, I'm up 50% on Caterpillar from an August trade. Am I gonna wait until 2024? Am I gonna wait another year plus to make the other 50% when I don't really know what's going on with Caterpillar and with the global market? I feel very safe about the put, but that's not the point. The point is, why don't I just take my profit off the table, and it leaves me, I have less risk going down, because if the entire market crashes, Caterpillar is going down with it. And then we sell more puts, then we sell puts, then we do more. Here's the same thing. Chevron, we made a quick 30%. GE from September made 50% already. Halliburton made 50% already from the end of September. I mean, it's like a month. Who's this one? OLM, we made 50%. QSR is done. They're going to expire in January. I probably in QSR, I don't want to. I'm going to skip. Why should I pay $250 when I have zero expectation that these are going to be out of the money? Here is real and that, and whatever. So we got to go through every position and be absolutely certain that we want to keep it, that we don't have anything better to do with this money, this net money. You know, here's Apollo. We only took this one in July. It's up, you know, what's that, 26 months, it's up about $13,000. We only started with a trade that was 29 minus 13 is 16, minus 5, so say 10. So it's about $10,000, and we made $13,000 already. How much can it be? Okay, what did I say? What are we taking off the table here? We got 50 minus 26 is 25. So basically 25,000 can take off the table. And at best, this is a $40,000 trade. So that's where we are. We've got 25,000 out of 40,000. We can make 15,000 more dollars if Apollo is over 60 next year. But will it be? Do I have better things to do with $25,000 and make $15,000 waiting for Apollo? It's probably 50-50 whether or not it goes up from here. It could go down easily. And again, easily, here's the problem. And again, here's something, a very important problem with the market or with a portfolio. You invest in individual stocks. Some are going to do well, some are not going to do well, right? This is like, you know what it's like? It's like playing craps at a casino. If you ever play craps, right? You put your money on all the different numbers, right? And if it hits your number, great, you're going to win. So sometimes your positions have good earnings, sometimes they have bad earnings. Sometimes an individual bet falls and sometimes it doesn't. But once in a while, those are pens, but it's like dice. So once in a while, craps. Somebody rolls a 7 and everybody loses. That's what happens when the market crashes, right? You will win some and lose some in your positions, and hopefully we're pretty good at picking them and we win more than we lose. But that's going to get us a certain percentage of gains, right? So let's say we make 20%, 30%, 40% going forward, right? Which is great. But that's because our winners outnumber our losers, and the way we position ourselves and the way we bet, we did a good job doing that. Fantastic. But what happens when there's a crash? What happens then? Then we lose. Every single position gets taken off the table. Every single position takes a hit at the same time. That's the house advantage against us when we're playing the market. That there are economic situations in which our whole portfolio can get hit at the same time. And yes, we have hedges, but the hedges get very expensive, and you get to a point where you're trying to hedge to protect a $7 million portfolio, or 6 million, or whatever the hell we're up to. So you get to the point where you're protecting a $6 million portfolio, and you can no longer make money. It's because it's too diverse, it's too difficult. You're basically playing like a prevent defense in football. You know, you're not playing to win it, you're not playing to gain ground, you're playing to stop the other guy from gaining ground on you. You're just hoping, and you're going to give up ground. You're planning to give up ground, just hopefully not too much. That's no way to invest. But every single quarter, there will be stocks that are completely oversold. No matter how bad the market is, there'll be oversold stocks. But you got to have the money to deploy. You know, the reason we did so well in 2009 and 2010 was because in 2008, we pulled the plug and we shorted things and we did the right stuff in the 2008. If we had hung on and saved our positions and tried to keep everything, we would not have had the money to invest in the good stuff. You know, we got out of Apple as it started taking damage because it got to a certain point. We were like, oh my God, this is crazy. It fell below. I can't even, it's hard to do with the numbers, but like, let's say, for example, it was up to 100 and it fell to maybe, all right, let's say it was 50. So maybe Apple was 50 or whatever it was at the time. I know it went down to 750. That's what I remember about it. So it was, let's say it was 50 and it fell to 30 or 4, about 30. And we were like, holy shit. And we pulled the plug. And of course, everybody's like, how can we pull the plug on Apple? And I'm like, because everything is collapsing and Apple's not going to be, isn't going to ignore it. It's going to go down with everything else. So we had a big Apple position. We killed it. And then we went back in when Apple went to 750. We were like, I'm like, buy Apple. And everybody's like, oh no, Apple's horrible. It went down like 80%. I'm like, yeah, that's why we're buying it. It's like, because now we have the money. We have the money from when it was down 50%. And now we're taking it, buying it when it's down 80%. So we're buying like 3 times more Apple than we sold for the same money. And then it went all the way back up, and we made a freaking fortune because we had the goddamn money to put into it. So you can't just ride these things out. You can't just sit there with your fingers crossed and hope everything gets better. You got to plan for the downturn, and you've got to be ready for it. So we've got, you know, just a huge short-term portfolio, a huge long-term portfolio in an uncertain market, and I think we're better off in cash. I really do. Now, we just did a review of where are we? So we reviewed a couple of portfolios yesterday. The thing about the Futures Now portfolio, it's very, very volatile though. I think I got to really like double and triple go over that with people. In the Futures Now portfolio, so here's our beginning of the portfolio review that we started on. Hello. How do you know when it's doing something? Oh, there it goes. So money talk we can change because we're not on the show, so that's fine. So we're stuck with it. But last time I was on the show in August, we cut half the portfolio, so only half the portfolio remains. The rest is cash. So 295 total value, 239 is cash. So we can easily double down on any of these, and that's exactly what I expected out of this. In 2 weeks, I'm going to be up on the 29th of November. I'm going to be up in Canada doing a thing for TD Wealth's high net worth client base. We're doing a special seminar. Let's see. I have no idea what I'm going to say. So this is the Futures Now portfolio, and I keep changing the name of it up front, but it's Futures Now portfolio. These are all stocks, and again, we went through all the positions, and there were really no cuts. BIIB, all we did is cover BIIB. We took the November calls off the table. November 10s were not worth selling. Oh, see, I said we should cash out if 8 doesn't hold, and here's 8 not holding. Rocket, we sold calls to cover. Sophie, we adjusted the position. And Sohu, we cut completely because I said, look, revenues are down and they're Chinese. I don't want it. Let's get out. But that's really the only one. Thor, we're still in. SunPower, we're still in, although they're doing well. Thor and WTRH is a dead issue. But these are stocks for a very long-term outlook that we think will do well in the future. So it's more of a watch list for things that we think are going to be good performers over the next 5 years, not things that are going to perform well in the next 2 years. But you have to be very well aware of that having this portfolio because it can drop very, very quickly. It can go to zero fast. This 79% can go to zero like lightning. And now the butterfly portfolio, of course, is a whole different animal because we don't care whether it goes up or down. We only care if we're selling enough premium to make money. As long as there are people who want to bet against us, we're happy to take their money. We sell high, we sell low, we sell everything in between. We just keep selling premium. And this one's up 1,000%. So it's like, it works well. It's a good strategy. And the butterfly portfolio is the only one that we didn't cut in the last purge because we, basically we cut everything in 2019, late 2019. We started new portfolios in early 2020 or late 2019. And so around Thanksgiving of 2019 is when we cut everything. Then COVID hit. I didn't know COVID was going to hit. I just knew the market was overpriced. Then COVID hit anyway, and that caused a total collapse. And that turned out to be great timing, which is again why we're doing so well in a lot of portfolios. We were all in cash or mostly cash when the market collapsed, and we started buying like crazy in the market collapse because we decided it was overdone. See, look, to some extent, it's great timing. And to some extent, that's luck. But to another extent, that's planning. We planned this. We expected, we had overdeveloped positions and we cut them and we cashed out because I wasn't sure what was going to happen in the fall of 2019. Here we are in the fall of 2022, 3 years later. I'm not sure what's going to happen. And if I'm not sure what's going to happen, I'd rather be in cash. Last time I said that, it was a phenomenally good decision. Just happened to work out exactly perfect. Doesn't mean it always will, but it did happen to work out exactly perfect when we did that. This year in August, I took the money off the table because we were overbought, because the market was overbought. Because when I look around and I can't find anything to buy, and that's really the gauge that goes on here. I'm always looking for bargains. And you can tell from the top trade alerts how often I'm sending them out, whether I see a lot of bargains or not, okay? So a month ago, we were sending out top trade alerts like crazy. We had that watch list we were doing. We were banging through positions, adding things to the portfolios. We had a ton of great stuff, okay? Now, not so much because everything got more expensive. There's no longer that many bargains around and certainly not compelling, and the situation is less clear. So when the market did drop in September, it was clear that we were hitting a bottom, that it was a good place to get in, and that the next couple of months I could see clearly we should be going up from there. That was obvious to me. All right, now we're halfway back to where we were, but where we were was overbought. So we're now at the correct place where the market should be, but I'm not certain about the environment going forward. Therefore, I don't really feel comfortable keeping too many positions open. Because you can't possibly double down on everything in your portfolio, not when everything is going down at the same time. And you end up being forced to cut things, even if they're perfectly good positions, because you can't afford to maintain them. We don't ever want to get in that position. We don't want to let ourselves get in that position. And it all comes down to, it's experience. It's a matter of saying we've been through this before. We've seen this before. We were talking about this earlier. And I was reminding somebody, and this is to somebody and one of the members who we went through this in 2008. I said, do you remember in 2008 when the market was collapsing, you couldn't even sell your goddamn position because the brokers kept crashing. They didn't pick up the phone. And the computers weren't working because they got overloaded with people trying to sell positions, and the market would keep closing for limit down days and things like that. It was a complete catastrophe. So you can't say, oh, I'm just going to set some stops. That's not how it works. Something would go down 10% in the morning, be limit down. The next day it would open, and 2 seconds later it would be limit down, and your broker still isn't working from yesterday. Crashes and panics are horrible, horrible things. And again, the guy who I said that to, he went through it. He remembered it when I reminded him, but he forgot about it otherwise. And that's my curse. I don't forget these things. I'm like that. It's a worry I have. I constantly think about that as, what's going to happen. And God, do you guys remember in 2008, you didn't know whether your broker would still be solvent. It was we were having conversations about what happens if, what happens if Thinkorswim shuts down? What happens if the whole company goes bust? Who's got this? Where is this money? Where are my certificates? What do I actually own? What rights do I have? That's the kind of shit we were dealing with back then. It was J.P. Morgan, Bank of America, Fidelity. You had no idea. Once Lehman and Bear Stearns went down, we had no idea who was going to be solvent tomorrow, or what would happen, or how you'd get the stocks. And that was, by the way, the people who had money with some of the bigger guys who had problems. They lost access to their accounts completely for weeks. They were not getting answers. So it's all well and good in a good market. I mean, look at these poor Bitcoin people, right? With the FXP or whatever, or FTX, whatever the name of these guys is. What happened to your money? It was tied up in some exchange. The exchange didn't follow U.S. banking regulations, and now it's gone. And they don't know that they can pay you. And all you thought you were doing was putting your money in a bank. Or putting your fake money, your Bitcoins in a bank. It's not a bank. It's not insured. And unfortunately, the ones that aren't in the U.S., that's why I like Coinbase. They're in the U.S. They have U.S. regulations. I would not invest in a company that's based in the Bahamas or anywhere else. Even the U.S. doesn't have enough regulations to cover it, but at least they're not going to go crazy with their assets. But you don't know what these people are doing with your money. It's like that Jimmy Stewart thing in Wonderful Life, right? It's like, no, I take your money and give it to him, and I give it to him. I don't actually have your money. He's a banker. That's what he's telling these people. I don't have your money. I lent it out. It's not here. You can't have it back. It's not available. God forbid people actually want their money. That's the end of it. That's what led to us having an FDIC insurance policy, but that's only $250,000. That's not going to do much for a lot of people. So, again, cash, and even the cash. You can't trust every bank. We're not in, by the way, the banking crisis of 2008. That's not going to happen again, or shouldn't happen again. But that happened because of a lot of excesses, and because the profits that they were claiming were not real profits. They were paper profits that reversed, didn't just disappear. The profits that were being claimed by mortgage companies, by banks, by insurance companies, so on and so forth, they were all based on a paper inflated housing market. And once the housing market deflated, the profits reversed. It wasn't just disappeared. It's not like the profits went away. They reversed. They became losses. And that's what was killing people. We're not in that situation now. I mean, there were warning flags of that thing forever. Warren Buffett was warning about derivatives at the time. I was freaking out about it because I came out of in 2005, I sold a company that was a real estate data company. So I was very in touch with the real estate market. In fact, the reason I sold it in 2005 was I expected the market to crash, and I couldn't believe 2 years later in 2007, it hadn't crashed yet. I sold this freaking company that was making huge amounts of money. And I said, I got out because I said, the market's going to collapse. We're making too much money. As an owner of a company, that was what I said. I said, we're making way too much money. This is not sustainable, because we made money on transactions. We were doing title insurance work and data for title insurance companies. And we were making money on turnover. So the turnover was great. The housing market was booming, but the way it was working was I would see the same house getting researched, and it was to our advantage because we would recycle the data. We didn't have to go and re-get the data. We would have the data already from 3 months ago. And when you're sitting there having meetings saying, you know what, we don't have to do that search again because this house was just searched 3 months ago. So let's start flagging in the system recent searches to make sure that we don't do more searches than we have to. And we said, oh, that's going to save us like 25% of that. 25% of the time we're doing a house, it's already been done in the last 3 to 6 months. And that's when you know the market's out of control. Consumers don't do this. It's all people flipping properties. It's all the same property getting flipped and flipped and flipped at higher and higher prices, and nobody ever actually moved into it. It's just a house got bought, sold, resold, sold, and sold, and it's not like there's families moving in and out every 6 months. They're empty houses being sold for ridiculous amounts of money. It was the writing was on the wall for that from miles around. In fact, one of the things that saved us was we were shorting the crap out of SKT. It was an ultra ETF on the banks. It was like some incredible, like 300. It ended up going down to like 10. We had shorted the crap out of it because I was saying for way too long, frankly. I'm like, this thing can't sustain itself. These numbers are not realistic. Same thing for Bitcoin. How long have I been telling people it's like Beanie Babies? It's a complete waste of money. Turns out, yeah, it's not real. So anyway, so it's just about, we have to look at things of what they're really worth, and you can't get too attached to your stocks. It's a question of, again, back to the $700 portfolio, okay? I can always, anytime we want to start, we didn't start this in an ideal time. We started this on August 25th. We started this at the top of the market. And I knew the market was going to go down. We knew that, but I said, here's a good time. I said, it's not a good time to start, but let's do this. It'll be a fun experiment during a down market to start, because I want to show that even if it's a down market, as long as you're steadily investing and going into something, you get past it. So we had some shares then, some shares when it went down. Now we're going to add some more shares, and eventually we'll collect dividends and we'll collect puts and calls. But meanwhile, we're going to make 20, 25%, 30% this year. And next year we'll get the dividends and there'll be more. So when I look at a position like whatever the hell we were looking at before, and I say, was it Disney? And I say Disney, and here we are. We have no, it wasn't Disney. It was somebody else. But we have 25 out of 40,000 potential in the position, and we can only make $15,000 over the next 16 months. It's like, no, I can do better than that. That's not enough money for me to stay in a position. We can certainly find something better. This is extremely restricted, what we have in this portfolio, but even extremely restricted, we're able to make 25%. We're not restricted in our options, and the more cash we have, the better advantage we can take of these things. Especially when things crash out, especially when the market falls apart. If it doesn't fall apart, great, we'll just buy some stuff that's cheap. We had a good 30, 40 different stocks on a watch list when we had the crash in September, and we probably put about half of those positions in our portfolios. That's why they're all full again. But that same watch list will be valid going forward, because what was the criteria of that watch list? People who make a lot of money per employee. So in other words, people with low head counts to revenues, because that way wage increases are not going to affect them as heavily, right? People who there are certain industries we avoided, things and not likely be avoided hit by COVID, so on and so forth. Things that were trending for the future, things that we felt would do well in a recession. People with low debt ratios. There was also a factor that took someone off if they had too much debt. I don't want to hear about anybody who's got debt, because it's going up. Rates are going up, and it's going to be a burden on the company. And the PEs had to be low, well below 20. That was another thing. Everybody, pretty much every single one of them with PEs below 20, because I don't want to overpay for anything. I think we're going to go back to an era where 15 PEs are going to be normal. And if that's the case, the whole market's going to trade down considerably, because we're still over that limit. And that's why the Nasdaq's vulnerable, and that's why the Russell is especially vulnerable, because the Russell is way over 50, way over 15. They're closer to 30. Still have the highest multiples. And it's not going to be justified if the economy is going to downshift. All right, so losing my voice, which means it's time to go. See if we have any questions. Target high PE and Walmart, that's why it took a big hit, although coming back some. Nobody cares about COVID anymore, says Clay. Natural gas popped so fast, couldn't catch it passing $6. Oh, I didn't see that. What happened to natural gas? Oh, wow. Yep. Oh, well, you know, like I said this morning, it held 575. I said I'd rather wait for it to either go to 550 or get over 6. And it popped over, it came hard and fast over 6, but it'll probably still come back down around 6. I wouldn't jump in overnight. I would wait and see tomorrow. We don't know why it even did that. How are the indexes doing? Nope, nothing. Not terrible, but not exciting, right? Go to a weekly view. So you notice the NASDAQ is way behind the recovery, and the Russell is actually staying quite a bit down. That 1850 line, we want to hold that. 12,000 failing is not a good sign. 4,000 failing is not a good sign. Yeah, so we're in shaky territory right now. The dollar did not cause this. Came back a little, but the dollar's not making any kind of significant move that would cause the market to do this. Oh, go Canada. Poor Canada. Metal, how's gold looking? Gold's up 1770. Silver's still high. Copper faded out a bit. Coffee, I'm liking at 150. I think that might hold. Sugar is crazy high. Cotton got a little bit more expensive, but no big deal. Lumber's still cheap. Bonds. Ooh, wow. A lot of people think the rates are going to be easing off here. Look at that. Those guys are all wrong. Everybody's wrong. Everybody's wrong. There's the picture you should be looking at. Here's the picture. The teeny little nothing, little weak bounce, and we're still on the way to hell for the bond market. And of course we are, because the Fed, we're at 4%, and the Fed's going to keep raising until we're at 6%, because inflation is not at 2% by anybody's stretch of the imagination, nor is it coming down to 2%. They have to tighten more. They have no choice. They're going to go to 6%. And that should be about June. And by June, inflation should be down below 6%. And then the Fed will be able to ease back. Not ease, I mean to stop raising rates. And then hopefully over the rest of the year, inflation should come back down to about 3-4%. And that should be enough for the Fed to keep them happy. But in order for that to happen, we have to not have a resurgence in COVID, not have a worsening of the war, not fall into a deep recession globally, not just the US. I mean, talking about the whole world has to avoid this. And of course, avoid worsening droughts, floods, natural disasters, and so on and so forth, which I was talking about today also. Where was that chart? We talked about this a couple of weeks ago, I think, didn't we? Here you go. So above average of $1 billion disasters, okay? It's just getting worse and worse and worse and worse every year because the weather is getting more and more extreme. And the costs are rising at an alarming rate, and now inflation is going to factor into this too. But you're talking about going from, this is a 5-year total. So it's an average, right? This is your 5-year moving average. 67, 119, 203. That was obviously a bad 5 years. 106, 418, bad 5 years. 232, 285, 788. Obviously a bad 5 years. But now the climate scientists are saying we can expect a lot of bad 5 years. And and if this number is going up in that kind of progression, you're going to see $1 billion, $1.5 billion, $2 billion. I'm sorry, trillion, $2 trillion, 10% of our GDP. So basically, what this is saying is in 20 years, 20% of our GDP every year will be fixing the shit that's broken because we didn't want to spend $2 trillion to fix climate change. So rather than do something about the climate change, we're going to have a constant recurring bill of trying to keep this country bandaged together in order to prevent collapse due to climate change, which will only get worse and worse because we never did anything about it, and now we're spending all of our money on natural disasters, and we don't have anything left to fight climate change. That's 2042. Anyway, so I guess when I talk about long-term investments, I'm really talking about 10 years time frame, because 20-year time frame, I don't know what the hell is going to happen. I mean, we could seriously be living in a disaster movie in 20 years. It really is horrifying. But that's where we are. So on that bright note, we're going to be going over the portfolios. We're going to be super careful about what's going on, and we're just going to be extremely wary of things that we keep. So I wasn't very harsh in the first 3 portfolios, but that's because I couldn't touch the money to our portfolio. Not that I really hate the positions or anything, but there were only 6 left. We already took out half the positions. And I picked the ones because I expected the market to turn down. I picked the ones that we'd survive a downturn. Remember, that was back in August when we purged the money portfolio. I would have, had we been able to go on the show in September and buy stuff, I would have bought stuff, but we didn't. So then what? Brain. Oh, I'm sorry. Yeah. So the money to our portfolio, we can't touch it anyway. No big deal. The future is now the butterfly portfolio makes money no matter what market direction. But the total collapse in the market is still bad for the butterfly portfolio. I just don't really expect a total collapse. I do expect, though, 20% more downside. And the future is now portfolio is long term. We wouldn't mind buying all the stocks if they get cheaper. We wouldn't mind buying more, but don't expect to make money. That's the key to that portfolio. Do not expect that that's going to make any money at all for the next 2 or 3 years. It's in a position building. It's in a position building sort of pattern at the moment, where we're kind of just hoping not to go too negative while we accumulate these positions and build them up. But the other portfolios, dividend, again, if things are getting crushed, I'm not sure if that's going to hold up. Earnings portfolio, again, it depends on what the positions that we have. There is the long-term portfolio has got the biggest problems. We're going to want to cut a lot of stuff out of that. And the short-term portfolio, as I said, it's just too much money. I'd rather have the money. I'd rather have the cash. So that's where things are heading at the moment. I don't see that changing much, especially based on the market action we're getting right now. And we will see what happens, all right? So we'll talk about it again next week after I make all my actual portfolio decisions. All right, well, thanks everybody for coming. I appreciate it, and we'll do it again next week. Oh, wait, next week's Thanksgiving? Oh, no, it's Wednesday. I'll do it next week. Yeah, we'll do a webinar. All right, take care.